The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I am Perry Sykes, and welcome to the Investor Resources Podcast.
So last week, there was quite a bit of uncertainty about what was going to happen with NVIDIA. And why was that important? It was because a lot of people were making an assumption that earnings couldn't be as good as they have been one more time around the block. But they were. And there's good news and bad news. The people that owned NVIDIA were continuing to celebrate its being in their portfolio. But there was bad news, and that is bad news in the hedge funds, because the hedge funds, many of which have been short NVIDIA, saying this type of price rise is unprecedented and cannot be continued. And they made their bets against that, and they just lost $3 billion betting that NVIDIA would be short or would be falling after the earnings announcement. But that is one of the mistakes people make with many financial decisions in their lives. It's not just betting on the stock market that will always go up, which over time has historically happened, but sometimes with very long interruptions in the rise.
Right. Long enough that you need to pay attention, long enough that they can ruin like a retirement plan. It's not like the S&P 500 has a bad, 2 weeks. We're talking about a bad decade or two. And that can really put a hole in whatever investment plans you have by believing the same thing that has happened before is going to happen over and over again into the future as long as I need it to happen, which is kind of how the belief works.
So we are momentum portfolio managers, and we're looking for things that continue to repeat in the short term. But many of the underlying assumptions in the financial market are things that repeat presumably over intermediate to very long terms. And with enough repetition, new investors assume that repetition will continue with a similar pattern over generally shorter periods of time. And that's just not reality. Sometimes these patterns are disrupted for extended periods of time. So one of the questions that's often asked, why is the market going up? Well, because it goes up.
There you go.
What else do you need to know?
That's it. And people, well, you can spend the rest of your life working to find that reason. Well, why is this happening? And for us, it's much more important that it's happening. Okay, the market's going up, and that means there's more people buying right now than selling. And we try not to care why. You can really get lost in the why. There's not always a good reason. Oftentimes, no one has a reason. They'll make stuff up. They'll invent something. Well, this is why it happened, but they actually have no idea why that's true or not. So that why question can really bog down what you do. And you need to stay, if you're going to be a momentum investor, you have to be nimble. You have to be willing to make those changes at a moment's notice. And you can't say, this has been a great investment for years, it's not going to change now. And the answer is that's wrong. It's going to change at some point. You don't know when, you don't know why, but the price is going to start dropping. You need to believe that for what it is and move on once that trend is set. And everything gets a little bit of room for noise up and down. But once you can see that you believe a trend is in place, you have to believe the trend, and you have to ignore, but this has been good for 5 years. Great. I'm glad it was. We're all glad it was great for 5 years, but it's not right now. And you need to be willing to make that change, or it's just going to eat all of your gains. That's the way you give it all back in the stock market.
Well, Japan has to be a classic market. I mean, it was a
Sure.
bull market for decades until 1989. 1989 peaked the Japanese Nikkei 225. This last week, it just regained its 1989 peak. Not
That's
paying
amazing.
attention means you're looking at 34 years of buy and hold trying to recover from having not paid attention 30 some odd years ago. That basically says you need to have a process. What is your process? If you're just investing because you were told to start early while you're young, well, now that makes sense, but doing so without a process does not make any sense. To buy the S&P 500 just because it's diversified across basically all of American industry, and assuming it will always generate your 10%, 8 to 10% average return, bad assumption. You go through long periods of time with no return whatsoever if that happens to be the decision you made. It's a decision without a basis and without a process. Dollar cost averaging is a sales talk, it's not an investment process. Dollar cost averaging into a declining 30-year bear market is not a winning strategy. Bonds, how about bonds? They're safe, right? That's what you're told.
Always.
In fact, the standard portfolio, 60% stocks and 40% bonds, relies on bonds for safety, relies on bonds really to reduce volatility of stocks on the assumption that bonds are less volatile. But we just saw that theory decimated over the last couple of years as the Fed raised rates aggressively and bonds lose value when rates rise. And we've had several banks that went bankrupt because they had large portfolios of US treasuries, long-term treasuries.
And there
That
you go.
wasn't so safe.
That's why those basic assumptions can be so misleading and so dangerous. It's like, well, bonds are always less volatile than stocks. And there may be long periods of time where that's true. There are also clearly now that we can see clearly times where that is not true in the least, to the point where banks that were buying 10-year treasuries bankrupt themselves because all of a sudden in venture capital land, everybody needed their money at the same time. Silicon Valley Bank was heavily into venture capital firms that were trying to put their money into something safe. Well, they bought 10-year treasuries. What could be safer, right? Well, then the Fed came along and raised rates every 3 months for a couple of years, and all of a sudden their treasuries were way underperforming. And it would have been okay if they had had years to unwind their position, but they were in the venture capital business, mostly in their banking industry, and everybody wanted their money now. All they could do was run out and sell them as fast as they could. But they had 10-year treasuries yielding 1% when you could go get 10-year treasuries yielding 4 or 5%. Theirs were worth nothing. Bankruptcy happened quickly. All of a sudden, the bottom dropped out of their safe investment, and they were out of business in no time from buying treasuries. So there's no such thing as well, I'm buying U.S. treasuries. There's no risk here. There is. There's always risk, and you need to acknowledge what it is. Figure out where that risk is coming from and do what you can to address it. But you need to have that exit strategy to say, if I have to unwind this all quickly and go somewhere else, what am I going to do? And we always know that going in. We know it once we acquire any security, what do we do to get out of this? We make sure we can get out just as easily as we get in, or we don't follow it in. That's the way you can get yourself trapped. And that's when you can really get hurt if you have to have a fire sale and move everything today, which is what happened at Silicon Valley Bank. They had to sell everything right now, no market for it. Everything went out on pennies in the dollar and they went under. That's the danger you set yourself up for if you don't both acknowledge, I'm buying this for the time being and I'm going to have to get rid of it. And when I do, how am I going to do that? You need to have both those things in place. That's part of that process you were talking about, Don. You have to have that process where you already know how that works for your portfolio.
let's talk about the issue of how am I going to get rid of it. With a stock, it's not a big deal because you go to your stock brokerage account and you look at it, and there you get prices updated on a constant basis during market hours. But when we're dealing with bonds, there's one of the big errors in assumptions is that bonds are less volatile than stocks. Even when interest rates are falling, bonds often have a higher degree of volatility than stocks do. Depends upon the stock, and it can have something to do with the bond. But the reason people think bonds are less volatile is because when they get their monthly statement, the value doesn't change rapidly. And that's because that price on the statement isn't based on trading activity for the particular bond. It's based on a mathematical calculation of the interest rate and the credit rating and the duration of the bond. And the math says the bond should sell for X. But if you're a bond trader, my goodness, bond traders are in and out of bonds with a high degree of activity. It's a much bigger market than the market for equities. And the trading occurs there, but nobody sees it on their statement, and it's never reported on the evening news. So the assumption is if we mathematically determine the price, the theoretical price of a bond only at the end of the month, and we ignore what happens from the first of the month to the end of the month, and what happens in the middle we ignore, then bonds are going to look a great deal more stable than stocks, where we're looking at every day going through the month. We make a bad assumption. Bonds have volatility. When it comes time to get out of the bond, it's unlikely that you're going to get the price that was on your last month's statement. Even if you wait till the end of the month to try and do that, the market is going to determine what that bond is worth at that time. So what
Correct.
we end up with is building the financial industry is built portfolios on a false assumption that bonds are less risky, and you just can sit back and be a slouch, forget about them. But that's not good advice.
Ever. Yeah.
It's not good advice.
Not these days. And you just can't rely on those. There are so many of those rules out there. Um, everybody should buy a home because home prices only go up. You should do that all the time. Everybody should go to college because a college degree guarantees great income for the rest of your life. Those are the kinds of things in markets and in life that you can't just blindly follow forever. Those things change. Those things become altered. And what made something lucrative for even generations previously may change completely from today going forward. It will not be the same. And you need to pay attention to that and not buy into it's always been this way, it's always going to be this way. And that's the way a lot of investing works, especially buy and hold investing. You say to yourself, this has been this way for 50 years, it's always going to be this way. And it is not. Things are changing too fast these days, and too unexpectedly. Everything heads in directions that no one could have anticipated, and you need to be ready to follow that change. You need to be ready to look at where the money's going and go where that is, even if it's somewhere brand new. Look at artificial intelligence now, like you were talking about at the beginning, Don. NVIDIA, no one knew NVIDIA was going to do what it did, including NVIDIA. Right place, right time, right product, and their business exploded. There was no business plan at NVIDIA to expand into artificial intelligence. Artificial intelligence didn't exist on a scale that would have done them any good. And it came from nowhere and then just absolutely took over everything they do. That's going with the flow. That's being adaptive. That's being able to say, we didn't see this coming, but it's here now, and it's time to ride this wave for as long as it's here, understanding it's going to change again, and you're going to have to be ready for that. That's kind of a change in investing. That the old get that diversified portfolio and sit on it for 50 years just doesn't get it done anymore. Things change too often, and they change too much to make that of any value. And that used to be, that's what made it safe. You were diversified. Now you can be diversified as you want. Everything you own could be doing poorly. That's not diversification. It used to be, may not be anymore. It's really important to keep an eye on that.
Well, one of the areas that you just touched on is housing. Well, a primary assumption of people buying a home is, well, I'm not going to lose any money buying a house, even if it's a little more
Right.
expensive than I want to pay. But part of that is a function of, well, it's not part of it. It's all dependent upon a couple of factors, one of which is demographic demand. One is economics. Are people employed, have jobs, can afford to buy? Is there adequate supply? And these things have changed radically. So part of the assumption long term is just like stock market long term assumptions. During the 70s, we had rapid price appreciation in many parts of the country. However, in the Northwest, suffering from the shutdown of the Boeing SST project, we had people leaving town. There was a sign in, you may remember this. I remember the sign. It was right after I came
Sure.
to Seattle. And there's a sign, southbound I-5, last person out of town, turn off the lights.
That was it.
And
And they
housing
weren't
was
kidding.
cheap.
Yeah.
There was nobody around to buy it. Housing was cheap.
Yeah.
I had a partner at the time who had been in his home for 20 years. He bought it in the 50s. Here in the mid 70s on Mercer Island, a few blocks from downtown Mercer Island, he couldn't find a buyer for the home. And he gave it back to the bank. Can you imagine
Unreal.
on Mercer Island? Well, it only took a few more years and demand changed. And so prices started coming back. And we go through some cycles. And the most recent one, when we had housing prices virtually collapse, was with the mortgage scam flipping houses in the 2000s. Buy the house,
Right.
flip it, double your money, whatever. And we had all these fraudulent mortgages going through the system. Prices were escalating because of buyer demand, but nobody was living in them. They weren't buying them to live in them. And when all of a sudden that game ended, prices dropped from '07, that was a peak, over the next several years. I know my personal home, my residence dropped by 50% in just a matter of
Yep.
a couple of years. And you're thinking, my goodness, this isn't very much fun. I thought real estate always went up.
Where's the always go up? That's right.
Yeah, well, the prices have now recovered again, but that's partly because of the problems of COVID forcing the shutdown of production of housing. And now we have a growing demand in the millennial generation. They're reaching the age of getting married, having families, getting ready to buy their own home where they have a backyard for their kids to play instead of the asphalt getting run over by traffic. So the
There you
demand
go.
has changed, but then the mortgage market changed and it restricts the motivation of people with a mortgage to sell their house because they don't want to give up a 3 or 4% mortgage to pay for a 7% mortgage. So we have an inventory problem, which will support prices, but it makes them less affordable for a first time buyer. These things cycle. Even if you're looking for gold, my goodness, we talk about this from time to
Sure.
time, but we were on the radio here in Seattle in the summer of 2011, and we said gold and emerging markets, if you own them, you should get them out of your portfolio because they have reached a cyclical top. And it's since 2011, gold has just come back to the level that it was back then. So we're sitting here looking at what, 13 years of a deep valley predicated on, and many people just assuming that either we're going to get a monetary collapse or inflation will drive the price up, and neither one of which have happened. And all the money you had tied up in gold has basically been dead money.
Yep.
The whole process of investing requires rules, a process, and somebody to pay attention. And if that's not what you're doing, call us because we'll be glad to do it for you, at least explain how and what we do. Somebody's got to pay attention. This is not for slackers. If you got questions, we'll be glad to talk with you. Send us an email or give us a call. Contact information is right here following this screen. Subscribe to our podcast. Hope you have a great day.